Hi everyone, Ryan Victorin here with another installment in our series on trading options. We're moving on to another common options buying strategy, and in this video, we'll be covering the protective put. We're going to explain how this strategy works, what makes it different from a long put on its own, and walk you through an example to show potential profit and loss scenarios based on how the price of the underlying investment changes. The protective put is a little more complicated than basic options trades because it involves two components. But if you understand how it works, it may help you execute your strategy. So let's take a look. A protective put involves buying a put like we covered in our video on the long put. The difference here is that you're buying a put on an investment that you already own or that you buy at the same time you buy the put. The two approaches are effectively the same, but when you buy a put and the underlying shares at the same time, you may hear it called a married put. Protective puts are typically used by investors who are bullish on the long-term prospects of an investment, such as a stock or an ETF, but who want to limit their downside risk in the short term. Those of you who are familiar with put strategies might be saying, wait, we're buying a put even though we're bullish? I thought you said buying puts was for investors who are bearish. That's true when buying a put by itself. But in this case, you're bullish because you like the investment that you already own or that you're planning to buy. By owning the stock, you have the potential to profit from any price increases. You just want the put as a kind of insurance policy against big losses, typically over some shorter period of time. An example will help show you what we mean. Let's say you buy 100 shares of QRS stock at $92 per share because you like its long-term prospects. But you're also worried about the stock falling around the company's next quarterly earnings announcement. So at the same time, you buy a QRS put with a $90 strike price for a premium of $1. And remember that each option typically covers 100 shares of the underlying stock, so one put will cover your entire stake of QRS stock. To see what happens if the stock price rises, let's take a look at this chart. Our first line shows your potential profit and loss if you only owned the stock. If the price rises, your maximum profit on the shares you own keeps rising too. Now let's add a second line showing what happens when you pair the stock with a put. Your maximum profit is still theoretically unlimited because you own the stock and will benefit as long as the price keeps rising. Okay, so what if the stock price falls? That's when pairing your holding with a put really transforms your risk. If you only owned the shares, your stock investment would lose value as the stock price declines. But adding the put has created a floor under your maximum risk. If the stock starts to tumble, you've locked in the ability to sell those shares at $90 anytime up to or at the contract's expiration date, even if it's fallen below $90. Let's see what that means in dollar figures. Your maximum loss is the $2 difference between your $92 stock purchase price and your $90 sale price, plus the $1 you spent on the options premium, so $3 per share. Because options typically cover 100 shares, the most you can lose on this strategy if you hold the put until expiration is $300. That's the $2 difference between the $92 stock price minus the $90 strike price, plus the $1 premium times the 100 shares that one contract covers. And $300 is a lot less than you might lose if you just purchased the stock by itself and it kept falling to $85 or $80 or even lower. That's the power of the protective put. You keep your upside potential less the cost of the purchased put while limiting your maximum downside. Now, you also need to know what happens if the stock price is essentially unchanged when your put expires. If the stock doesn't rise or fall by much, then a protective put strategy will underperform compared with just holding the stock alone. That's because the cost of the premium will reduce your overall return. So that's how a protective put works, and the reason why options traders typically use this strategy. We've now covered 3 different buying options in this series, and you may be wondering how to choose which strategy is right for you. To help you decide, we offer the Options Strategy Builder on Fidelity.com. It gives you step-by-step instructions to find the right strategy for your outlook, time frame, and needs. Well, that's all for now. Next up, we'll look at some common options selling strategies to help you keep building your options knowledge. In the meantime, if you have any questions about options trading, please drop them in the comments section below and hit the subscribe button so you can get notifications for future videos. Thanks for watching, and I'll see you soon.